increasing your cash flow without selling your property. How do you do it? What are ways to do it? What do I actually mean when I'm saying those words? So when it comes to like, it's all around the borrowing capacity and lending, right? So there's certain ways, and in the previous pod we discussed, ways to renovate your property to either sell or to increase your rent. So
so that's one way.
Yeah, one way, renovate it, because that way it's a better property, and people are willing to pay more money for a better quality property. It's pretty simple, right?
Yeah, and once you renovate it, you can increase your rent, or number two, you could sell that property and buy a better asset that does provide a better cash flow, I guess.
Yeah.
In terms of like getting out of one thing and moving to another investment because of the opportunity cost of holding that investment that you've just done a renovation on.
Yeah, and there's certain cycles in life where even selling down an asset, if that's the last thing you want to do is sell your asset, because that's increasing its capital value year after year. However, if you do sell down that asset, you're realizing that gain, that profit that you've got can be put into either offsetting another mortgage. So that's increasing your cash flow because you've got less debt. That can give you that freedom and flexibility to a strategy is you buy multiple properties, you sell a few down, and then you're done. There's your cash flow component because you've got less debt. So that's one way to increase your cash flow. Talking about renovating too, that's one way to increase your cash flow. The other sort of more complex methods are you're doing that subdivision. So you hold that asset, you sell off the vacant block of land at the back. That gives you an extra couple $100,000. You use that to either offset further debt, or, as you said, buy another asset with a higher cash flow component.
And with that subdivision, you could put a property on it as well if you have the ability to finance it, and there's ways that you could finance it with equity.
Yeah. So you do the subdivision. You now have got two lots. You've increased that equity in the total property because you get a saleable asset. Instead of selling it, you then use that equity to help you build a house, and that's going to give you a rental income. So that's increasing your income, increasing your cash flow. There's some really cool little strategies around that. And then another part that we delve into, and the key here is to, by increasing your cash flow in the bank's eyes, you're going to have greater serviceability. So they're going to be able to lend you more money.
Increase your borrowing capacity.
Yeah, right? Increase your borrowing capacity. So you're less of a risk to them. And with able to increasing your cash flow, a key strategy that you use as you're growing a portfolio is to draw down upon the equity that's in there. So banks will look at your household income, your investment income, pull that together and say, well, based on these income streams, we're happy to lend you X dollars. So what some people do is, when I say don't sell your properties because they're increasing in value and you're doing nothing, that's that passive side of investing that we're all about. What you can do is, by increasing that cash flow initially, you might not have much cash in the bank after that renovation or subdivision or build, but you've got that higher cash flow coming through. You can then refinance that your whole loan structure. This is not financial advice, by the way. I'm going to throw that one in there. It's speak to your mortgage broker, your accountant, their licensed professionals. It's just general advice that I've come across in my years of doing this. But what you're essentially doing is using that cash flow to pull equity out, and that's going to give you a lump sum of cash essentially. So if you, as an example, you've got $800,000 in debt, your cash on your portfolio, your cash flow can now help justify up to $900,000 in holding debt. So you can refinance that. You pull that $100,000 out. Essentially, you're paying the debt now on $900,000 from a cash flow perspective,
which is a really important thing because there's pros and cons to drawing equity out.
Yes. So it's like, well, you now have $900,000 in debt from the bank's ledger, but you've got an extra 100 grand in cash sitting there in your offset account. So that's a strategy that people use to then go, well, I can now go buy another property as that's a deposit for another home.
Mm-hmm.
It depends on where you're at in your lifestyle, right? Like some people want the new home, some people want the holiday, they want the car. Biggest issue with those things is you're pulling money out. It's like your future money you're pulling out. If you're putting that into a depreciating, some call it asset, I call them liabilities,
Like a car. You're basically, I guess, if you go and take 100K out and you're also buying a 100K car, you're basically getting finance for a car, right? Because that 100K is going to get added to your mortgage. So you're basically getting finance on a car. It's not like I'm just pulling out cash and I'm buying this with just cash. Like, well, no, you've put like you put that extra 100K on your mortgage, which you'd still need to pay whatever percentage of interest on that, right?
Yeah.
And then that doesn't go very far when you are buying a holiday. So you're buying a 20, 30K holiday, then you're financing a holiday with debt.
Yeah. So you're actually borrowing from your future self to do those types of plays. And that's why if you're borrowing from your future self to buy an asset that appreciates in value and gives you good cash flow,
like buying another investment property.
That makes logical sense.